Welcome back.
I'm Nick Shivers.
And I'm Keegan Shivers, and this is the Shivers Report, where you get the most up-to-date real estate information
in the world,
and more specifically in the Pacific Northwest. So one of the big things that we've been seeing a lot, not as much in the residential space, but in the commercial space, is it seems like commercial real estate it has crashed.
It has definitely crashed.
We have seen that across the board since COVID. I mean, there was a big change for a lot of people when it came to work. A lot of people went remote, and it hasn't come back. Why have we seen commercial real estate crash while residential real estate really hasn't seen that big of a crash, even though there's all these headlines about the problems that we have in the residential real estate market?
Yeah. So first of all, I think we have to define commercial. Commercial is several different. There's office space.
Yep.
There's multifamily, and there's medical.
Yep.
And depending what we're talking about, they've all been beat up a little bit, but office space has been decimated, and just like you addressed, remote work is more certain cities. Since we're here in Portland today, let's talk about that. Since 2019, vacancy rates in Portland are up 80%. There's 80%, and that is people aren't going downtown as much. People are leaving, businesses are leaving that area. So that multifamily is a little bit different story. Where we're seeing multifamily crash, you're not seeing that necessarily in the Pacific Northwest because we didn't have as much building. We had oversupply. We had everybody was a guru back in 2020, 2021, and even 2022. And they syndicate, they raise capital, they bought everything, banking on rents continuing to go up. And rents, just like appreciation in the residential market, rents have been going down. So those are the reasons why commercial, office, and multifamily, but two different reasons. One is actually demand. One is oversupply. That's the difference on that.
Do you think also with some of these syndications that happened, I mean, everybody was jumping on the multifamily wave. If you listen to Bigger Pockets talking about syndications, how you can syndicate to be able to raise capital to go buy these deals, it felt like there were a lot of people that may not have actually known the actual business that were going and raising an unreasonable amount of money and buying these properties, and now are kind of they don't know what to do.
Right. I remember, I think it was 2020 when we went to Tulum, Mexico for that business event. And I was listening to this guy talk about his syndication, and he knew nothing about multifamily. And I was sitting there going, there was like that fear of missing out. I'm like, what in the world? Lo and behold, I've looked at his little thing that he was investing in. They're all in default, every single one of them. Because, yes, when everything's going good, everyone's a guru. It's when things start going soft. But why is it if we know office is because the demand plummeted, but multifamily, why is multifamily down 40, 50%, and residential is down, depending on where we're in down Portland, Multnomah County, down 8%, but downtown commercial is down 60, 70%. What is the biggest difference?
So the beautiful thing about residential real estate is you can get fixed rate interest rates.
Yeah, fixed rate debt.
Fixed rate debt. And we see this. Canada doesn't have fixed rate debt, and commercial property in America doesn't have fixed rate debt.
No.
So when everybody was buying up these multifamilies, these office spaces, these industrial buildings at 3 point whatever percent interest rates, if you didn't have the factor in there of what could happen if interest rates went up, that's something that some people didn't even think about because they were living in the now and not thinking about what could happen in the future.
Yeah.
Making deals happen with the best possible outcome in mind and a lot of people have ran into problems with that.
Yeah. I think there's one other country in Europe that has 30-year mortgages like the U.S. does, and that has saved. That is the biggest difference also between now and back in 2008 and 2009. Now we have fixed rate debt. Now, don't get me wrong. If you bought a house in late 2022, 23, 24, you had higher rate debt, and now things are a little more challenging. That's where we're seeing, even though foreclosures are historically low, but fixed rate debt saved it. I've been looking at some properties in Texas, and they're not. It's not like they have major vacancies. They were making money when their interest rate was at 3%.
Yeah.
And then now it's at 6.5%. And they're in trouble. And they're wiping out their investors, or they're having to bring major capital calls in to cover that. And the guys that really knew what they were doing, they would get basically the rate caps. They would buy rate caps on these commercial loans where it couldn't go up too much, and they can still make it happen. But those rate caps cost a lot of money. It's an insurance policy.
Yeah.
And that is the biggest reason we had a lot of people jumping into the investor game, multifamily, because when everybody's talking about it, people are jumping on the bandwagon, and now a lot of people are getting smashed. And the biggest difference, you don't hear it as much, because it's not affecting Main Street as much as it does affect Wall Street. That's why private credit is getting smashed.
Yeah.
And even companies like BlackRock and Blackstone are saying, hey, you can only take out a certain amount of money. You can't take out all your money, because they know they're in trouble.
So do you think, in certain areas too, are doing better than others? Real estate is hyper local, no matter residential or commercial. Do you think in the Pacific Northwest, Portland specifically, the bleeding has stopped yet, or do you think there's more to come?
No, I have a perfect example. I think we talked about, we had that property that was in contract for $4 million, and there was a fire right next door, and it was already on a major discount, and the buyer said, I can't do it because of the crime in the area. I'm moving out of Portland. So until that gets solved, I still think we have some pain.
And sometimes, typically commercial real estate, no matter what, will still trickle into residential a little bit.
Absolutely.
Because we haven't seen such a major drop off. Maybe we've seen a flat line since 2022 and the rates went up, but we haven't seen that major decrease in prices, unless you're in an area that built like crazy and the supply is Florida, Texas, certain areas. Do you think we're going to see any more of that, any more bleeding on the residential side?
Yeah, a little bit.
Going to flatline
I think
still?
we were talking about this the other day. We had, every indicator is we'll see depreciation this year.
Yeah.
And again, when businesses leave areas, it's not as, and if we have crime, homelessness, if the businesses are leaving, so are the potential residential.
Yeah.
The saving grace in Portland Metro is we have the urban growth boundary. We just don't have enough, even though our demand has dropped, because our domestic migration has dropped.
Yep.
Our supply is still being able to keep up. Even though if we look, 35% of all properties in Portland Metro and Clackamas, Washington County, up to 45% of all properties on the market have seen price reductions. Price reductions is a lead indicator for price compression. That being said, we're still up 18 to 35% in values compared to 2020. To cap it up, number one, the reason we have not seen a big crash in residential is fixed rate debt.
Yeah.
And it will continue to bleed over a little bit to 1 to 2% depreciation. Now, if we factor in inflation, that depreciation is 4.5%.
Yeah.
4.5%.
Yeah,
So,
with inflation coming out last week, rising to 3.3%.
yeah, we're 5-6% depreciation, real depreciation.
Yeah.
So
So it'll be interesting to see if we see any more of that trickle into the residential market. But at the same time, the amount of people that have fixed rate debt under 6% is the majority of the nation. Right?
Yeah, I think 50% of all loans currently in the U.S. are under 4%, and 20% are under 3%.
Then 82% from Redfin data came out and said that are under 6%.
Yeah, so that's solid debt.
Thanks for tuning in to the Shivers Report. If you have any questions about real estate, we have you covered.
We're out.